So one of the conversations we have had, and I certainly want to get your thoughts on it, is this idea that there is this disconnect right now between the markets when you see something like, for example, the NASDAQ 100 less than 0.5% from its February high, and the economy, given some of the really difficult data we've been getting, and then, of course, from a societal standpoint, social unrest. How do you see that disconnect?
Well, I think if you look back on maybe the last 3 times the market has gone through a really tough spell. You had in the late 1980s when value was very out of favor, and that was more a disconnect in the market between cheap stocks and value stocks. We had something similar in the internet bubble around 2000, where traditional businesses had very low PEs and technology businesses had very high. A decade ago, in the financial crash, it was very different than that. The whole S&P was very cheap relative to trend earnings. I think the situation we're in right now is more reminiscent of those older bear markets than the one we went through a decade ago. I think it's hard to argue the S&P is seriously undervalued here. It sells at a high teens multiple of expected earnings. Yet within the market, you have bank stocks that are selling at 4 or 5 times trailing earnings, and you have other businesses that are at multiples in the upper double digits. It's hard for me to imagine a world where the S&P is worth 18 times earnings, and a bank that is gaining market share, that's seeing its expenses go down, isn't worth more than a quarter of that multiple.
Yeah, it's such a key point because there is the broader market right now and the moves we're seeing there. But then when you actually look under the hood and you start to dig down among sectors and among companies, there are a lot of disparities here, which is why I wonder what you think of the rotation we have been seeing in recent days, whether it is within financials, industrials, materials, some of those particularly hard hit stocks, airlines, retail, et cetera, that do seem to be getting a bounce right now, although still admittedly very, very much beaten down year to date on these reopening hopes. Is that where you see value right now, or where would you be investing?
Yes, I do think that's where the value is. When we ended 2019, we thought the economy would likely stay moderately strong as it had been for the past decade, that based on that forecast, there were a lot of industrial stocks that were cheap, banks were very cheap, and we thought some of the commodity stocks, including some of the oil names, were also cheap. Obviously, that was not the place to be invested in the first quarter as we went into a severe recession scenario caused by COVID. But I think as the news on COVID keeps getting better and you can start to see a path out of the recession that we're in, those same names that looked cheap at the end of 2019, that were miserable performers in the first quarter, have been some of the best performers since the bottom, and to us still look really cheap. A name that it seems like I talk about every time I come on here, Ally Financial, it was selling at $30-some a share around the end of the year, expected to make something like $4.50 in 2020. That stock got down to 11 at the bottom. It's rallied to 18, but at 18, it's still only 4 times the number they were expected to earn before we had to mark up 2020 charge-offs due to COVID. I think by 2021, 2022, this is going to show it is a very, very cheap stock. And most of the other banks are similar.